Very good morning, my dear soldiers. We are in the chapter Internal Reconstruction of Companies. So, as on last session, we done with entire concept related things for the chapter Internal Reconstruction. So, without directly entering into the problems, so let's first give a quick recap till now what we have discussed in this specific chapter. You can treat like this is mind map as well. So let me give mind map or the recap for internal reconstruction. Guys, the word either internal reconstruction or external reconstruction, both the objective. Whatever the objective I specified in case of external reconstruction, the same objective is going to applicable in case of internal reconstruction as well. That is to show financial statements at true and fair view. We are going for internal reconstruction. And that too, in case of internal reconstruction, no liquidation of existing company, right? And in case of internal reconstruction, is it court approval mandatory or not? Yes, without having the court approval, we may not go for internal reconstruction. And one more thing, after completion of internal reconstruction, each and every company should need to use the word and reduced for a specific time, as for the court decree should need to add the word and reduced while presentation of financial statements. So such all things we discussed uh, during the process of internal reconstruction, right? And next, sir, what are the various methods available for internal reconstruction we discussed? So if you remember, what are the various methods I discussed? That is alteration of share capital we see, alteration of share capital. We discussed variation in shareholders' rights. Reduction of share capital. Then compromise and arrangement. Yeah, 1 second. Suddenly stopped. Okay. So after reduction of share capital, compromise and arrangement. And one more method is surrender of shares. We not yet discussed anything related to surrender of shares. Sir, in case of alteration of share capital, increase in authorized share capital is coming to alteration of share capital only. And consolidation and subdivision of shares is also coming to the picture in case of alteration of share capital. Conversion of shares into stock and vice versa, that is stock into the shares, is also coming to the alteration of share capital only. In case of variation of shareholders' rights, either the right related to voting or maybe the right related to dividend may change with respect to either equity shareholders or preference shareholders. Then that method of internal reconstruction we can known as variation in shareholders' right. And in case of reduction of share capital, we've seen totally three situations. That is situation number one, reduction in unpaid capital. Unpaid capital. So situation number two, That is reduction in unpaid capital through conversion of partly paid up shares into fully paid up shares, if you really remember. So situation number 2, we check that reduction in paid up value due to payment made to existing equity shareholders. Situation number 3, reduction in paid up value due to sacrifice made by the existing shareholders. So totally 3 situations we seen. Sir, in case of reduction in unpaid value, that is conversion of partly paid up into fully paid up equity shareholders, just there is change in face value, nothing will happen. To be frankly speaking, there is no reconstruction profit or loss will arise. So I told you as on that day, the example, if 8 rupees shareholder is paid up, but the face value is 10 rupees. Now the face value will become to the 8, paid up value also will become to the 8. That is equity share capital accounted are to equity share capital. You can cancel the old face value, paid up value 8. You can create new face value, paid up value 8. Reduction in paid up value due to payment made to existing equity shareholders. So 10 rupees face value, 10 rupees paid up, let us assume. Now out of which you are paying 2 rupees, then equity share capital account at our old 10 rupees face value, 10 rupees paid up value, to bank 2 rupees, to equity share capital 8 rupees. Face value is 8, paid up value is also 8. Right? Sir, for example, there is no change in face value, but there is only reduction in paid up value. If that is the situation, there is no change in face value, there is only reduction in paid up value due to making payment. Then at that point of time, you can directly write this entry, equity share capital to bank 2 rupees. No need to cancel the 10 rupees face value. The reason is the same 10 rupees face value is going to continue in the future as well. So coming to the third scenario, as I explained, reduction in paid up value due to sacrifice made by the shareholders. Then again, there are 2 situations. That is situation number 1. Sir, reduction in paid up value and face value. So there is reduction in only paid up value, but not face value. If there is reduction in paid up value as well as face value, then the entry is equity share capital to reconstruction to equity share capital. Let us assume you can take the same example which I considered here. The only difference is not the 2 rupees payment, 2 rupees is sacrifice. Then equity share capital old face value 10, old paid up value 10. You should need to cancel. To reconstruction, sacrifice is made 2 rupees and new equity share capital is 8 rupees. Paid up value is 8 rupees. So there is reduction only in paid up value, but not in face value. That means no need to cancel the face value. Then equity share capital to reconstruction account, 2 rupees we can directly pass. You understand the difference, all these guys? Next, in another method, that is compromise and arrangement. So rigorously we discussed the concept of compromise and arrangement. In case of compromise and arrangement, a specific agreement will be agreed in between company and the stakeholder of the company with respective to payment aspect related to that particular stakeholder. So the major difference between compromise and arrangement is, in case of compromise, after a lot of negotiations, a final agreement will take place in between the 2 parties. In case of arrangement, so at the inception itself, both the parties agreed for the terms and conditions what they are agreed. We discussed various examples in case of compromise and arrangement. So the agreement may be different from one particular agreement to another particular agreement. So out of the important example, just I want to discuss here. So the only one important thing in case of compromise and arrangement is I should need to check how much amount sacrifice made by the stakeholder. To the extent of sacrifice, I should need to make it transfer to the reconstruction account. That's it. But sometimes the sacrifice may be the gross sacrifice. Sometimes maybe the sacrifice will be the net sacrifice. Sir, that means in return, if the other party is not expecting anything, then gross sacrifice, you can just make it transfer to the reconstruction account. Sir, in return, if the other party is expecting something, you should need to make it transfer the net sacrifice. I will tell you the basic difference in between two. What is that? Sir, in return, stakeholder is not expecting anything. But in return, if the stakeholder is expecting anything, how it differs to each other. For this, let us me take one example. Sir, bank loan is there to the extent of 5 lakhs, out of which 2.5 lakhs is ready to sacrifice by the banker. And for the remaining 2.5 lakhs, we are going to pay in the form of cash. Due to this sacrifice, in return, banker will not expect anything. Then at that point of time, to the extent of gross sacrifice, that is 2.5 lakhs, simply I should need to make it transfer to reconstruction account. That is bank loan 5 lakhs to reconstruction 2.5 lakh to cash 2.5 lakh. The same situation, let me explain in this manner. Sir, banker is ready to sacrifice 2.5 lakh provided in return if we are going to issue 1 lakh worth of equity shares. Banker is ready to sacrifice 2.5 lakh. In return, if the company is going to issue 1 lakh worth of equity shares, then only banker is ready to sacrifice 2.5 lakhs. Then at that scenario, gross sacrifice is 2.5 lakh, but in return, he is expecting the equity shares for 1 lakh. That's when the net sacrifice will be 1.5 lakh. That's why for this 1.5 lakh only, you should need to make a transfer to reconstruction account. Then at this scenario, how the entry will become? So entry is bank loan account data, that is 5 lakh, to the extent of net sacrifice, that is to reconstruction account, that is 1.5 lakh. In return, they are expecting equity shares for 1 lakh. That's why to equity share capital 1 lakh. Remaining 2.5 lakh, as usual, you can pay cash. Like this, you should need to pass the entry. Hope you understand these points as well. So right, sir, after completion of this entire internal reconstruction procedure, what I should need to do, sir? I should need to find balance under reconstruction account, balance of reconstruction account. Now, with the balance of reconstruction account, whether it is clearly mentioned in the problem or not, irrespective of such fact, P&L account debit balance, you should nullify with reconstruction account balance. Why? The objective of internal reconstruction itself is showing the financial statements at true and fair view. That means whatever the accumulated losses we had in my balance sheet, I should need to make it nullify with the profits arised due to the reconstruction account. Now, at that scenario, the journal entry is reconstruction account debtor to P&L account. And one more important thing, just I'm telling at this moment, sir, in the problem, if it is clearly mentioned to knock off any unrepresented intangible assets. Unrepresented intangible assets means in book we have the goodwill, but that company really doesn't have any goodwill. Maybe in the company books it has some patents, but it doesn't have any outside market value. Then at that scenario, if it is clearly mentioned in the problem, then only you should need to nullify such intangible assets with reconstruction account profit. Sir, if it is not mentioned, no need to knock off the intangible assets. But coming to P&L account debit balance, irrespective of the fact whether it is mentioned or not, you should need to nullify the P&L account debit balance with reconstruction account. Do you understand? So that means intangible assets, if it is specified in the problem, I will nullify. Sir, after knock off with this P&L and specified intangible assets, still if any balance is there under reconstruction account, it should need to be transferred to capital reserve. Sir, if the reconstruction account balance is not sufficient to knock off this P&L or intangible assets, then you can utilize the other reserves, if at all, if it is available in that particular company. If the reserves are also not available, simply to that extent of reconstruction only, you can just go for knockoff, right? So these are the important facts I told you. So 1 second, guys. Next, one more important thing, just I want to inform you. Sir, we've seen the various methods of internal reconstruction, right? Out of that, only reduction of share capital in situation number 3, that is reduction in paid up value due to sacrifice made in the shareholders and a compromise and arrangement. Anyway, surrender of shares, we not seen it. In these two situations or in these two methods of internal reconstruction only, we seen the reconstruction account or capital reduction account. In the other methods of internal reconstruction, either in case of alteration of share capital or variation in shareholders' right or reduction of share capital, in these two situations, reconstruction account doesn't come into the picture. That is my another observation. That means in the problem, if at all reconstruction is going to happen, other than this compromise and arrangement and reduction of share capital through sacrifice made by the shareholders, no need to involve the reconstruction account. Is it okay, guys? So I think so. Up to this part only I discussed in the last class, and the same things. So just I portrayed here as a mind map. Just a second. Oh my God. Let me open the query box. Hope you guys are comfortable till now. Yeah, fine. So right. Uh, as I inform you, surrender of share concept, I don't want to explain right now. So let's complete the problems on the various issues except on surrender of shares. So then at the end, I'll put the surrender of shares concept, then we can go ahead with the problem based on surrender of shares. Okay. So without wasting much time, let me directly entering with problems. So all of you, please come to problems section, guys. So if you're having the hard copy, please make it handy, or otherwise just you can concentrate on screen itself. Just give it a moment, guys. Yeah, it's all right. So problem number 1, on 31st December 2011, B Limited had 20,000 rupees 10 equity shares as authorized share capital, and the shares were all issued on which 8 rupees was paid up. So 20,000 equity shares at the rate of 10 rupees each will be authorized share capital, and a paid up value out of 10 rupees will be 8 rupees. In June 2012, the company in general meeting decided to subdivide each shares into 2 shares of 5 rupees each with 4 rupees paid up. So simply subdivision of shares, which is related to subdivision of shares. In June 2013, the company in the general meeting resolved to consolidate 20 shares of rupees 5 having paid up value 4 per share into 1 share of rupees 100 each, that is rupees 80 paid up. Pass entries and show how the share capital will appear in notes to the balance sheet as on 31st December 2011 31st December 2012 and 31st December 2013. So simply at the first instance, subdivision is going to happen. And again, in the next instance, consolidation is going to happen. The same thing we see in alteration of share capital method, right? Sir, literally, conceptually, nothing much to explain here. Only you should need to pass the journal entries. Let me directly explain this with my help of PDF itself. Okay. Because clerical issues, I should need to write much. Let me directly explain with this. So, right. So, which is related to alteration of share capital, as I already explained you. Now, subdivision is going to occur in June 2012. So, that's why June 2012 subdivision. So, first, you should need to cancel the old face value, that is at 10 rupees. Each share into 2 shares means the new share capital will be 5 rupees. There is no change in the paid up value because earlier is also same paid up value, now also same paid up value. So equity share capital old face value 10 to equity share capital new face value 5. So paid up value will be how much, guys? So paid up value will be 20,000 into 8, which is 1,60,000. So the same paid up value is going to continue. But in the narration, you should need to clearly provide that being each equity share is going to subdivided into 2 shares, as a result of which 20,000 equity shares are converted into 40,000 equity shares at the rate of 4 rupees paid up value. The same narration you should clearly provide. So just here narration not provided completely. So just you should need to provide the narration also complete manner. Next. For consolidation, again, when consolidation is going to occur, consolidation is going to occur in June 2013. Again, the same way, you should need to cancel the old face value, which is at the rate of 5. You should need to credit the new face value at the rate of 100. That's why to equity share capital old face value 5, to equity share capital new face value 100. There is no change in the paid up value. Again, you should need to clearly provide the narration being each equity share is consolidated into 20 shares, as a result of which 40,000 equity shares are converted into 2,000 equity shares. So complete narration you should need to provide. Is it okay, guys? So notes to accounts also nothing much, guys. The same as on June 2012 authorized share capital you can provide. How many number of equity shares multiplied with paid up value, you will get the figure should need to shown in the balance sheet. Similarly, as on June 2013, you should need to provide the notes to accounts. Just I included this problem, how the impact of alteration of share capital will be there under notes to accounts. Nothing much. In an examination point of view, they never tested this type of questions. If at all they test, okay, those are out of pocket marks only. Fine. You can come to problem number 2, guys, all of you. C Limited had 5 lakhs authorized capital on 31st December 2011, divided into shares of 100 rupees each, out of which 4,000 shares were issued and fully paid up. In June 2012, the company decided to convert the issued shares into stock, which is related to conversion of shares into stock. But in June 2013, the company reconverted the stock into shares, each fully paid up. Sir, it's very easy. At the first instance, the conversion of shares into the stock is going to happen. That's why equity share capital you should need to cancel. To equity stock you should need to credit. Later, equity stock you should need to debit. Equity share capital you should need to credit. Sir, amount is how much? That is fully paid up. So 4,000 into 100, that will be 4 lakhs. Here also 4 lakhs. You know one thing, sir, why he is telling that existing shares are fully paid up? The conversion of shares into the stock is eligible as per Companies Act 2013 if the existing shares are fully paid up. Partly paid up shares are unable to convert into the stock. With that reason, it is clearly showing that all the existing shares are fully paid up. Narration also you can simply provide at the first instance, being conversion of 4,000 equity shares into the equity stock. So later on, the equity stock is going to convert into the equity share capital. As I told you, why they are going for this type of conversions. Now, during the process of internal reconstruction, if they want to make payment for any particular stakeholder, they can simply make payment through equity stock. So in any denomination, they can able to divide in case of stock. But in case of the shares, they should need to follow the particular denomination. With that reason, people are generally going for conversion of stock. Okay. So that is altogether problem number 2, guys. Now, the real reconstruction problems is going to start from problem number 3 onwards. Please all of you concentrate, guys. Problem number 3. I hope there is no doubt till what I had discussed in this chapter. So that's why I didn't spare much time on for your doubts clarification, and I didn't see any doubt as well in the query box. So after this problem, just let me give some time space to you to discuss about your queries if you have anything. Okay. The balance sheet of A and Co Limited as on 31st December 2011 is as follows. So started with fixed assets, freehold property is given, plant is there, patent is given, goodwill is also given. So total of the assets value related to fixed assets given. Next, trade investment at cost price 55,000. Under current assets, trade receivables given, inventory, profit and loss account. So total value is given. Next, coming to liabilities, share capital, cumulative preference shares of rupees 100 each given, equity shares of 10 rupees each given. So total share capital is 11,50,000. Next, 6% debentures secured on the freehold property, 3,75,000. We have the freehold property here, right? This freehold property is provided as a security to the debentures. So that's why in bracket it is clearly mentioned secured on freehold property. Accrued interest on this debentures given at 22,500. Next, under current liability, bank OD is there, trade payables is there, director's loan is there, total of the current liabilities. The court approved a scheme of reorganization to take effect on 1/1/2012. You know, so the entire scheme should need to be approved by the court. Unless otherwise it is not approved by the court, the company is not eligible to initiate the internal reconstruction procedure. So that's why in the problem it is given that court already approved the scheme of reconstruction. So that's why the reconstruction is going to impact with effective from 1/1/2012. The preference shares to be written down to rupees 75 each and equity shares to rupees 2 each. What is the meaning of this? Whenever the preference shares and equity shares are written down means if nothing is mentioned, they are going to sacrifice the other amount. It is the indirect meaning. Do you understand? It is the implicit meaning that whenever there is a reduction, always we should need to think that if otherwise any specific thing is provided, we should always presume that reduction happened through reduction in paid up value as well as reduction in face value also. As I informed you, if you remember in the last class, whenever he is talking about reduction in paid up value due to sacrifice made by the shareholders, unless specifically mentioned, you should always presume that there is reduction in paid up value as well as face value. So that's why what I should need to presume here or what I should need to treat here, the preference shares new face value is 75 rupees, new paid up value is 75 rupees. Equity shares new face value 2 rupees, new paid up value is 2 rupees. If you check the existing face value 100 rupees, 100 minus 75, 25 rupees per share will be the sacrifice made by the preference shareholders, and 10 minus 2, 8 rupees will be the sacrifice made by the equity shareholders. Okay, we'll write one by one entry. Just hold for some time. Let me read the problem from top to bottom. Of the preference share dividends which are in arrears, for 4 years, 3/4 to be waived, and equity shares of rupees 2 each to be allotted for the remaining quarter. Guys, just 1 second. Let me come back to my mind map. I forgot to include few things while discussing the mind map. What is that, in case of after discussing the compromise and arrangement, I discussed some special issues, if you remember. In the special issues, what I discussed, I discussed about unrecorded liability or asset accounting treatment. In case of unrecorded liability, if it is sacrificed, no entry. Sir, if it is discharged at greater than their book value or less than their book value, I don't mind, or at book value. It is generally not discharged at more than book value. So if it is equal to book value or less than book value, whatever the case may be, the entry is reconstruction to bank at the rate of discharged value. This is the conclusion I made, if you really remember. Sir, in case of the asset, due to that realization, due to that specific asset realization, nothing will come. That is realized at the rate of nil book value. Then there is no entry. Because if you want to record the entry is reconstruction to asset, if you realize it, then you are not getting anything means, sorry, at the time of recording of the asset to reconstruction, if you are at the time of realization, nothing you are recovering means reconstruction to asset will cancel with each other. No, sir, the realization happened is equal to book value or greater than book value or less than the book value, whatever the case may be. Then the entry is bank account at R2 reconstruction account at the rate of realization value. The same thing you should need to put in your mind. So apart from this, I told you one more special aspect, that is revaluation of assets and reassessment of liabilities. This concept also I discussed. In the recap, I forgot to tell you. So in case of assets, there may be a chance of upward revaluation or maybe the downward revaluation. In case of liabilities also, there may be a chance of upward revaluation, downward revaluation. Sir, in case of upward revaluation of asset, the entry will be asset to reconstruction. In case of downward revaluation, the entry is reconstruction to asset. In case of upward revaluation of liability, reconstruction to liability. Downward revaluation of liabilities, the entry is liability to reconstruction. Now, based on this specific thing, they are provided point number 2. Of the preference share dividend, which are in arrears, which is nothing but arrears of cumulative preference shares. If you observe the preference shares of cumulative preference shares, arrears of cumulative preference shares for 4 years, out of which 3/4 to be waived. Sir, 3/4 to be waived means out of this liability, 3/4 was sacrificed. Out of the unrecorded liability, 3/4 was sacrificed. That's why no need to provide any entry. And for the remaining 1/4, equity shares of 2 rupees each to be allotted for the remaining quarter. Remaining quarter means for the remaining 1/4. Sir, at which value we are going to discharge? For that particular value, the entry will be reconstruction account at R2 equity share capital. So reconstruction to bank, if it is the paid in the form of money. If it is, we are going to issue the shares, reconstruction to equity share capital. I'll explain each and everything in my OneNote. No worries. Just for the time being, just I'm explaining here itself. Okay. Hope you understand the point related to unrecorded liability. Next, coming to point number 3, accrued interest on debentures to be paid in cash. So accrued interest on debentures means this 22,500 was paid in the form of cash, accrued interest to bank account. If it is paid means liability to bank. Next, you can come to point number 4. Debenture holders agreed to take over freehold property. Book value is 1 lakh at a valuation of 1,20,000 in part repayment of their holdings, and to provide additional cash of rupees 1,30,000 secured by a float charge on company's assets at an interest rate of 8% per annum. All of you read this sentence carefully and let me know the accounting treatment in the query box, or before providing the accounting treatment, what is going to happen? Can you please explain, anyone in the query box? So understanding of the problem is pretty much important in case of internal reconstruction. Otherwise, you may not give the correct accounting treatment. Still, I am waiting for the answer. First, we should account for revaluation, sir. Okay. So I'll do one thing. Just give me a second. Anyway, I'm reading one by one, right? So which is problem number 3. So in the first point, what they told in point number 1, okay, what they told, preference shares are written down to 75 rupees each and equity shares are written down to 2 rupees each, right? So which is related to share capital, what it told, preference shares reduced to 75 and equity shares reduced to 2 rupees each. So if I provide accounting treatment for this transaction, the existing preference share capital I should need to cancel. That is 4,000 6% cumulative preference share capital. Simply 6% is cumulative preference share capital. So face value 100. How much, guys? 4 lakhs. To 6% cumulative preference share capital. 75 each. So is it amount is 4 lakh only, right? 4 lakh into 75% means, which is 3 lakhs. So remaining to reconstruction account. That is for 1 lakh. I'm explaining one by one in OneNote itself. Otherwise, it will be double count. Need to explain twice. Then a third point, I'll tell you what the point is all about. Okay. So in case of equity share capital, reduced to 2 rupees each means first you should need to cancel the existing face value. Equity share capital account data, that is existing face value 10. How much was given? 7,50,000. To new equity share capital will be 2 rupees each. 2 rupees each means 75,000 multiplied with 2, which is 1,50,000. To reconstruction account. 75,000 into 8. How much? To the extent of 8 rupees will be sacrificed, na? 6 lakhs. So the remaining amount is 6 lakhs. So narrations I'm not providing here. You can just write the narrations as per your view. Okay, no one will object you. Next, this is the first entry. This is the second entry. Next, what happened? Of the preference share dividends, which are in arrears for 4 years, cumulative or arrears of cumulative preference share dividend. Total for 4 years. For 1 year, which is how much? 4 lakhs into 6% is 24,000. 24,000 into 4 years will be the total dividend. Out of which he is clearly telling that 3/4 to be waived off. 3/4 to be waived means no entry. So for 1/4 they are expecting equity shares. So for 1/4 means which is for 24,000. So for 24,000 they are expecting equity share capital means whenever we are discharging the unrecorded liability, the entry is reconstruction account at R. 2. Cash if it is paid in the form of cash. So now we are issuing in the form of equity shares. That's why equity share capital. How much? 24,000. So always the new shares, whenever we are issuing, the face value is how much? It is always 2 rupees. Please be remember the new face value of the equity shares will be 2 rupees each. That is 12,000 equity shares at the rate of 2 rupees each. This is related to arrears of cumulative preference dividend. So this is third entry. Okay. Next, guys, no need to explain all these things. You can directly pass the entries in the exams. Just for your understanding, I'm explaining one by one. Now, if you come to third one, accrued interest on debentures to be paid in cash. So if you paid in the form of cash, the entry is accrued interest account at R to bank account, right? So the fourth entry is accrued interest account at R to bank account. How much? 22,500. Now if you come to the point number 4, debenture holders agreed to take over freehold property, book value 1 lakh at a valuation of 1,20,000. Now something he is talking about debenture holders as well as freehold property. First, let me talk about the freehold property. What he is telling indirectly for freehold property. Sir, freehold property existing book value is how much in my books first? Freehold property existing book value is 4,25,000. Let me take that freehold property book value 4,25,000. Out of which he is talking about 1 lakh book value of the freehold property. Out of this 4,25,000, 1 lakh book value he is talking. What he is talking? This 1 lakh book value at a valuation of 1,20,000 is taken over by the debenture holders. That means, first of all, there is upward revaluation of freehold property indirectly, right? They are taking it more than book value means you are doing the upward revaluation for freehold property. Sir, for 1 lakh book value of freehold property, there is an upward revaluation by adding 20,000 means the entry is freehold property account at R2. Reconstruction account, that is 1,20,000 or 20,000 just. If you make 20,000 by addition, automatically freehold property is showing at the rate of 1,20,000 only. Super. Sir, out of this 4,25,000, just now I had talked with 1 lakh. What about the remaining 2 lakh, remaining 3,25,000? What about that remaining 3,25,000? If you check here in point number 8, remaining freehold property to be revalued at 3,87,500. Sir, remaining freehold property, book value 3,25,000. They are revaluing at the rate of 3,87,500 means again there is a upward revaluation to the extent of how much? That is here upward revaluation 62,500. Sir, again, no need to write freehold property to reconstruction double time. What I will do here, upward revaluation 62,500. Here, upward revaluation 20,000. If you add these both, 62,500 plus 20,000, total it will become 82,500. It is better to write one entry 82,500. Do we agree? This is entry number 5. It is better to write one entry freehold property to reconstruction because part of the freehold property 1 lakh is revalued at the rate of 1,20,000 means upward revaluation profit 20,000. The remaining other part 3,25,000 is going to be revalued at 3,87,500 means the upward revaluation profit 62,500. If I add both, then the entry will be freehold property to reconstruction account 82,500. After that, what is going to happen for debenture holders? First, let me explain. So for debentures, what is going to happen? So debentures, I have 6% debentures. For that 6% debentures, book value is at 3,75,000. Right? Do you agree? Now, out of this 3,75,000, first I am discharging 1,20,000 with the freehold property. Remaining balance will be there 3,75,000 minus 1,20,000. Remaining will be 2,55,000. So anything discussed about 2,55,000, then I will discharge like that. If nothing was discussed, then I will simply show in the balance sheet for the remaining balance of 2,55,000. Now let me read here anything he specified related to debentures or not. Let us check. Debenture holders agreed to take over freehold property book value 1 lakh at a valuation for 1,20,000. Okay, part payment of debentures over in part payment of their holdings and to provide additional cash of rupees 1,30,000 secured by a floating charge on company's assets at an interest rate of 8% per annum. Guys, this is altogether a new transaction. What he is telling, to provide additional cash, to provide to whom? Company. To provide additional cash to the company, the existing debenture holders are ready to subscribe to the extent of 1,30,000 debentures. Those are 8% per annum debenture holders. He is not talking anything in further about this 2,55,000. This 2,55,000 is still continue as a liability. In addition to this, the existing debenture holders to augment some cash, they are subscribing to the extent of 1,30,000 worth of debentures. So now all of you concentrate. For the additional subscription, the entry is bank account data to 8% debentures account. Do you agree? That is for 1,30,000. Sir, nothing is specified. That's why it is continue as a liability in the balance sheet. Related to this 1,20,000, we are discharging by offering the freehold property. So that's why the entry is 6% debentures account data to debenture holders. First, you should need to transfer. Then you should need to discharge the debenture holders. That is debenture holders account data to freehold property. This is the entry. Otherwise, you can directly discharge 6% debentures to freehold property as well. But first, you should need to make a transfer to debenture holders. From there, you should need to transfer to freehold property. So just give entry number. This is 678. This is the thing you should need to follow. This is all about point number 4. Hope you understand. Okay. Next. So guys, 1 second. I'll do one thing at this moment. Please, all of you go for the break because a lot of noise is coming from my outside. Otherwise, I will try to complete this problem. Then I want to provide the break. You can take a break till 8:05. Okay. Then my side also environment will be a little bit peaceful. Then we can continue our remaining problem. But just now I completed till the end of point number 4. Let me try to complete the remaining problem post the break. Okay, please all of you assemble by 8:05 guys, exactly. Yeah, right. Welcome back, guys. So we done up to problem number 4 before the break, right? Sorry, point number 4. Now let me continue the discussion with point number 5. Patents and goodwill to be written off. Okay, what are the items should need to be written off? Let's put the journal entries at the last instance. Let's pass a single journal entries for all the items which should need to be written off. Okay. Uh, so let me give different color just to identify this. Okay. Inventory to be written off by 65,000. Inventory also at the last instance. Let me write off. Amount of 68,500 to be provided for bad debts. Sir, if you want to provide any provision which is an additional burden, which is nothing but creation of a liability only. Now, what is the entry you should need to pass? Reconstruction account at R2 PBD account. So at the time of recording any unrecorded liability, which entry you are passing? To record that liability, you are passing reconstruction to liability, right? Similarly, here also you should need to pass reconstruction to provision for bad debts, which is also something like that written off entry only. How you are going to write off any particular expense. Similarly, recording of unrecorded liability, this entry. So this is also, let me do it at the last instance. Point number 8, I already considered remaining freehold property to be revalued at 3,87,500. I already considered. Trade investment be sold for 1,40,000. So let me write the entry for point number 9, guys. Okay. So this is for me entry number 9. So trade investment be sold for 1,40,000 in books. Trade investments how much? So trade investments is at 55,000. The 55,000 worth of trade investments, I'm going to sell at 1,40,000. That is profit or loss? Profit. So during the reconstruction, if you derive any profit or loss, that should need to be transferred to reconstruction account. So bank account at R 1,40,000 to trade investments. Book value is at 55,000. So profit 1,40,000 minus 55,000, which is equal to 85,000 to reconstruction account. Right? So 55,000 worth of trade investments we sold for 1,40,000. So the net profit or loss on sale of investments just we are transferring to reconstruction account, which is 85,000. Next, directors to accept settlement of their loans as to 90% thereof by allotment of equity shares of rupees 2 each and as to 5% in cash and the balance 5% being waived off. Now if you check here, director's loan will be there for 1 lakh, right? First, director's loan will be there for 1 lakh. Now out of which what is talking, directors to accept a settlement of their loan as to 90% thereof by allotment of equity shares. Now out of this 1 lakh, 90% is through allotment of equity shares. That is for 90,000. Of 2 rupees each. So existing equity shares are 2 rupees only. And as to 5% in cash, remaining 5% is in the form of cash, that is for 5,000. And the balance 5% is being waived off. So balance 5% is waived off, means transfer to reconstruction account, that is for 5,000. Now you can pass the entry, which is 10th entry. Director's loan, you should need to make it debit because we are discharging a liability. So director's loan account at R 1 lakh 90,000 worth of equity shares you are issuing. That's why to equity share capital in bracket face value 2 amount will be 90,000. To cash 5,000. To reconstruction, which is 5,000. Is it okay, guys? This is about director's loan. Next, there were capital commitments totaling rupees 2,50,000. These contracts are to be cancelled on payment of 5% of the contract price as a penalty. Sir, what about this, sir? Capital commitment means maybe construction of any building, maybe any purchase order. So what we committed to deliver earlier as according to our business, we have the commitment of 2,50,000, but we are unable to honor that particular contract because which become onerous. Do you know the meaning of onerous contract? Onerous contract means rather than doing that particular contract, our organization will end up with losses. If we are honoring that particular contract, then definitely our organization will end up with losses. Rather than honoring, it is better to cancel that particular contract. At least we can save some amount of loss. So at that instance, the organization will definitely cancel the commitment and by paying certain penalty as per the contractual commitment. At the time of entering into the agreement itself, we clearly agreed that if you are unable to deliver or if you want to cancel that particular commitment, then we should need to pay this much of penalty. So right now, the organization is going to cancel that capital commitment. So that's why we should need to pay 5% contract price as penalty. This is an additional expenditure incurred due to making decision during the process of internal reconstruction, right? So at the time of making payment of cash, then the journal entry is actually expense to cash. This is the entry. Now, during the process of internal reconstruction, any expenditure should need to be transferred to reconstruction only. So reconstruction to expense is the entry. So expense credit, expense debit. That's why the net entry is reconstruction account at R2. Cash. How much? Penalty amount. 2,50,000 into 5%. 2.5 lakh into 5%. So which is 12,500. So 12,500 will be the penalty, guys. So the entry reconstruction account at R to bank account 12,500. Is it okay, guys? Next, ignore taxation and cost of the scheme. You are requested to show the journal entries reflecting the above transaction, including a cash transaction, and prepare the balance sheet of the company after completion of the scheme. Sir, I done all the points except point number 5, 6, 7, right? Because these are related to written off entries. Okay. What I will do, patents and goodwill to be entirely write off. So if it is specifically mentioned in the problem to written off, you can go with the written off. Inventory to be written off by 65,000 only. Amount of 68,500 to be provided for bad debts. So let me write the entry for these three line items, that is 12th. If you are written off means debit the reconstruction account, which is loss, right? Reconstruction account at R to patents and goodwill first. So patents and goodwill in balance sheet, how much amount it is given? So let me club the both and write at a single instant patent and goodwill 37,500 plus 1,30,000, which is 1,67,500. 1,67,500. If you want bifurcate 37,500 plus 1,30,000. Okay. Next. Inventory to be written off by 65,000. Inventory 65. So 4,25,000. If you written off 65,000 to inventory 65,000. Next, you should need to create a provision for bad debts, which is 2 PBD. How much amount you should need to create provision for bad debts? 68,500. should need to make it transfer to reconstruction account, the total amount. But first of all, let me do one thing. Before entering with this word or before writing the entry number 12, first let me check one thing, guys. How much balance of profit I derived through this process of reconstruction? Let me calculate. Do you understand? Now, after finding the balance under reconstruction account, I will start nullifying the patents and goodwill, inventory, PBD. Still, whether it is mentioned in the problem or not, I should need to nullify the P&L account debit balance as well. Tell me, guys, because in the problem it is clearly given our organization is a loss-making company. I am having the P&L account debit balance for 5,35,000. So definitely I should need to cancel the 5,35,000 as well, clearly with the reconstruction account. So that's why before providing the entry number 12, first of all, let me finding the reconstruction profit and the reconstruction profit, whether it is sufficient to nullify all these items or not, I will check later. Is it okay? Fine. Now let me start with point number 1, that is first journal entry. All of you please ready with your calculator. In first entry, reconstruction profit 1 lakh. So give positive figure 1 lakh in your calculator, plus second entry, reconstruction 6 lakhs. Second over third entry, reconstruction debit, that's why minus 24,000. Minus 24,000. Fourth entry, no involvement of reconstruction. Fifth entry, reconstruction credit, that's why plus 82,500. Sixth entry, no reconstruction. Seventh entry, no reconstruction. Eighth entry is also no reconstruction. Ninth entry, reconstruction plus 85,000. 10th entry, reconstruction 5,000 plus 5,000. 11th entry, reconstruction minus 12,500 because debit. Yeah, that's it. Before passing the 12th entry, I got the balance under reconstruction is 8,36,000 as per my calculator, guys. Is it correct? Can you please confirm you all? 8,36,000. If it is 8,36,000, out of which I'm nullifying 1,67,500 for patents and goodwill, 65,000 inventory, 68,500 for PBD. Let me reduce this first. 8,36,000 minus 167,500 minus 65,000 minus 68,500. Still, I have 5,35,000 balance here. After this, I have exactly 5,35,000 balance. The 5,35,000 exact balance, I can nullify with P&L account debit balance. So P&L account debit balance simply nullified with the balance of reconstruction account. So total you can put here 8,36,000. After this, there is no balance under reconstruction account. If at all, if any balance is there under reconstruction account, I would transfer to capital reserve. But here there is no balance after nullifying all these items. That's why no need to transfer any amount to the capital reserve. So entire balance under reconstruction account itself is knock off. Is it okay? Fine. In the exams, actually, what you should need to do, just I orally calculated the balance of reconstruction as 8,36,000. But you should need to open the reconstruction account ledger. What are all the entries impacted for this reconstruction account? Debit aspect should need to record under debit, credit aspect give under credit. The net balance you should need to identify. Then one by one you should need to knock off the remaining balance. Simply you can knock off with the P&L account debit balance. Still, if you have any balance, you can make it transfer to capital reserve. That is the thing you should need to follow. You should need to open the reconstruction account. Just to save my time, I made all the computation through orally by using my calculator. Okay. So this is all about journal entries, guys. Hope you understand the journal entries part. Now I should need to work out the balance sheet part. Let me start with balance sheet. So preparation of balance sheet is a little bit important in case of reconstruction because each and every item should need to be worked out carefully while drafting the balance sheet. Balance sheet of, what is the company name? A and Co. Balance sheet of A and Co. as at 31st December 2011. In bracket, what you should need to mention? And reduced. This is important. If you are not mentioning this one, then examiner will reduce your marks as well. Okay. Balance sheet of A&D company as of 31st December 2011 and reduced. So let's start with equity and liabilities. Under that, shareholder funds, A, share capital. So let me give the note number 1. Can come here, notes to accounts. So note number 1 is related to share capital. Under that, first let me discuss about equity share capital. Okay. So please all of you check the entries here one by one. Wherever the equity share capital impact is there, I should need to consider. First entry related to preference, leave it. Second entry related to equity. Old 7,50,000 is converted into 1,50,000 by sacrificing 6 lakhs worth of equity shares. That's why you can consider 1,50,000 only. 1,50,000 plus third entry 24,000, that is plus 24. Fourth, no involvement. Fifth, no involvement of equity share capital. Sixth, seventh, nothing. Eighth, also nothing. Ninth, also nothing. 10th, equity share capital, you can add plus 90,000. 10th, nothing. Sorry, 10th equity share capital 90,000 added. 11th, nothing. And the 12th, also nothing. So I got total 2,64,000 worth of equity shares. That is equity. Each equity share is 2 rupees, means 1,32,000 equity shares. That is 1,32,000 equity shares at the rate of 2 rupees each. Amount will be 2,64,000. Similarly, you can work out the preference share capital as well. So in case of preference share capital, entry number 1, 6% cumulative preference share capital for 3 lakhs plus second nothing, third nothing, fourth nothing, fifth no, sixth, seventh no, eighth also no, ninth no, 10th no preference share capital, 11th, 12th also nothing. So that's why only I have preference share capital for 3 lakhs, guys. Oh, so each and every preference share at the rate of 75 each. So that's why 4,000 preference shares at the rate of 75 rupees each. I will get 3 lakhs. So total 264 plus 3 lakhs, which is equal to 5 lakh 64,000. So in share capital, you can put 5 lakh 64,000. So in balance sheet, just now I cross verified, the share capital will be 5 lakh 64,000. So after share capital, be reserves and surplus. Guys, any excess of reconstruction balance over P&L account debit balance, we are transferring to capital reserve. But if you check in point number 12, exactly the reconstruction account balance is sufficient for all the items to be written off, and P&L account debit balance as well. That's why there is no excess of reconstruction. That's why we doesn't transfer any amount to the capital reserve, right? And in any way, securities premium account is also not coming to the picture. That's why the existing reserves and surplus P&L account debit balance was completely nullified. If you check here, we are having some P&L account debit balance. This was completely nullified. That's why right now under reserves and surplus, no need to give any amount here. That's why reserves and surplus will be nil. Do you understand? P&L account debit balance was nullified. No amount transferred to capital reserve. No securities premium. Nothing. Existing reserves and surplus except P&L account debit balance. Nothing we have. That's why right now it will be nil. So after shareholders funds, the next line item will be non-current liabilities. Under non-current liabilities, I have 6% debentures only. Accrued interest was completely paid off. So that's why you can give something like this. Non-current liabilities. Under that, A, long-term borrowings. Give note number 2. Long-term borrowings. Now check with the entries, all of you. Wherever the debentures impact is there. First, second, no debentures. Third one also nothing. Fourth, payment. Fifth, revaluation. Sixth, now concentrate. Out of this 6% debenture 3,75,000, 1.2 lakh we discharged. Remaining 2,55,000 just treated as liability in the balance sheet. And further, we issued 8% debentures for 1,30,000. Now the issue is 6% debentures is for 2.55, 8% debentures is for 1,30,000. So 6% debentures is for 2,55,000. 2,55,000 and 8% debentures. How much, guys? 1,30,000. So total will be 3,85,000. So now the same thing you should need to represent here, 3,85,000. So after long-term borrowings, what I have, because accrued interest I paid it off, that's why it doesn't come into the picture under balance sheet after reconstruction. Next we can come for current liabilities. So current liabilities, bank OD, I have the negative cash balance. That's why I represented the bank OD. But I should need to work out the total cash balance. If I have the positive figure, I should need to represent under assets, cash and cash equivalents. Still, I am getting the bank OD. I will represent under current liabilities. That's why put it on code. Let's work out the bank OD at the end. Bank OD or bank balance. Now you can come for trade payables and director's loan. So trade payables, I think so. Nowhere we touched it off. Director's loan, we entirely discharged. Something was sacrificed, something was issue of equity share, something was paid in cash. If you are not believing me, you can check here. Director's loan, entirely we're done. That's why director's loan doesn't come into the picture. Only trade payables that we consider at this instance. So under current liabilities, only let me consider the trade payable because we are not touching that. So the trade payable is 3 lakhs. If bank OD will also come, I will add at the end. Okay, let me start with assets, guys. Then under assets, non-current assets, freehold property, something I edited, plant, not touched, patent and goodwill, written off. Don't consider these two. So that's why non-current assets, only these two will come into the picture. Let me go to notes, non-current assets. So freehold property. Now, if you check here, the freehold property, out of 375, sorry, above. Out of 4,25,000, 1 lakh was revalued for 1,20,000, later on issued to the vendor holders. You can ignore this. For the remaining amount, 3,25,000, I revalued at 3,87,500. This was not given to anyone. That's why still I should need to show this part, 3,87,500 in the balance sheet. So that's why you can consider 3,87,500. Freehold property, 3,87,500. This is PPE. Note number 3 is for PPE. So apart from freehold property, plant is there. Plant is there for 50,000. Now total how much? Which is 437,500. Can give the same here in the balance sheet. So under assets, not having space here, let me draft the other components of the balance sheet here. So assets, non-current assets, under that a PPE 4,37,500. Is it fine, guys? Next, trade investments were also sold out. That's why it will not come into the picture. Trade receivables, PBD is there. I should need to reduce the PBD. Inventory, something was written off. So in current assets, let me take directly the current assets. Under current assets, A trade receivables. So given at 4,85,000 in the balance sheet minus PBD. So PBD amount is how much? 68,500. 4,85,000 minus 68,500. 4,16,500 and inventory. So reduced with 65,000 inventory given for 425 minus 65,000 you can reduce. Which is 3,60,000. So accept cash, everything I worked out, everything I considered. That is, let me check the bank balance. First start with the balance sheet figure minus 1,95,000. Now start with entries guys one by one from first entry onwards. First entry there is no cash or bank, second nothing, third nothing, fourth minus 22,500. Fifth nothing, yes. Sixth also nothing, seventh nothing. In eighth I'm having positive plus 1,30,000. Ninth plus 1,40,000. 10th minus 5,000. 11th minus 12,500. I got positive 35,000 cash balance here. If I have the positive cash balance, I should need to represent under current assets the name of cash and cash equivalents. That's why bank code will not come into the picture. Only cash and cash equivalents 35,000 under assets. Now you can check total of the liabilities and assets. 564 plus 3,85,000 plus 3 lakhs here. It is 12,49,000 guys. This side also you can check 437,500 plus 416,500, 360, 35,000. 12,49,000 this side also. So this is a full-fledged problem based on the internal reconstruction. Now out of which is painful, you know, passing the entries is also easy. Understanding the content given in the problem as well as drafting the balance sheet here is a little bit pain because each and every component will be impacted due to this internal reconstruction. Should need to clearly check each and everything. Hope it is understand for everyone. Just let me know if you are facing any issues. You can take a deep breath for 1 minute. If you are having any doubt, just let me know before starting with the next problem. Any doubts, guys? Today, no doubts. I'm saying under the query box. Okay, guys, let's start the next problem, which is problem number 4. All of you, please come to problem number 4. Given below is the summarized balance sheet of Rebuilt Limited as on 31st March 2011. Building at cost plus depreciation was given. Plant after depreciation given. Trademarks and goodwill at cost was given. Inventory is there. Trade receivables, profit and loss account, debit balance. Next, you can come to liability side. Authorized and issued capital. So which is issued capital as well. 12,000 7% preference shares of rupees 50 each. Note preference dividend are in arrears for 5 years. Amount is given at 6 lakh. Equity shares at the rate of 50 rupees is 7,50,000. Loan amount was given. Trade payables is there. Other liabilities given. The company is now earning profits short of working capital, and a scheme of reconstruction has been approved by both the classes of shareholders. A summary of the scheme is as follows. The equity shareholders have agreed that their 50 rupees share should be reduced to 2.50 by cancellation of 47.50 per share. They have also agreed to subscribe for 3 new equity shares of rupees 2.5 each for equity shares held. So this is something related to equity shares he is providing. So if you check the equity shares face value is 50 rupees, 50 rupees share should be reduced to 2.50 each, means 47.50 per share should need to be transferred to reconstruction account. They have also agreed to subscribe for 3 new equity shares at the rate of 2.50 each for each equity share held. This is new subscription. For this new subscription, total I have 15,000 equity shares. Each and every existing shareholder is ready to subscribe 3 new equity shares, and each and every new equity shares will be 2.50 per each. So 15,000 multiplied with 3 into 2.5, which is 1,12,500 worth of new equity shares were subscribed by the existing shareholder. And for this, what is the journal entry? Equity share capital account at R50 to equity share capital in bracket face value 2.50 to reconstruction 47.50. Just if you multiply with the number of equity shares, total amounts you will get. Okay, so let's pass the entries for point number A and B. So which is problem number 4, right? Problem number 4. So just I want to write the problem a little bit quickly. That is equity share capital 50 amount will be 7,50,000 to equity share capital 2.5. That is 15,000 into 2.5, which is 37,500 to reconstruction account. It is 7,12,500. Next, second entry, bank account at R2, equity share capital account. So which is how much, guys? 1,12,500, which is subscription of new equity shares, right? Which is 2.50 per share. Is it fine? All of you will agree? Next, the preference shareholders have agreed to cancel the arrears of dividend and to accept for each 50 rupees share for new 5% preference shares of rupees 10 each plus 6 new equity shares of 2.50, all created as fully paid up. First, there is arrears of preference dividend. So if the arrears of preference dividend was completely sacrificed by the preference shareholders, then what is the entry? No entry. For this, no entry. Right? Up to this, sorry. And to accept for each 50 rupees share for new 5% preference shares of 10 each. 4 into 10, it will be 40 plus 6 new equity shares of 2.5 each. 6 into 2.5, that is 15. So 40 plus 15, if you add, which is 55. That means for every 50 rupee share, I'm issuing 55 means, which is not profitable situation, which is loss situation. Loss is how much? To the extent of 5 rupees per preference share will be the loss. Do you understand the point here? Let me explain here. So the preference share capital actually exists 6 lakhs, which is 12,000 preference shares at the rate of 50 rupees each. Now he is telling that the existing preference shareholders, we are cancelling, no doubt about it. But as a result, we are issuing 4 new 5% preference shares, 4 new 5% preference shares at the rate of 10 rupees each. That is, existing 12,000 means 12,000 into 4 into 10 rupees, which is equal to how much? Which is equal to 4,80,000. And he is also telling that plus 6 new equity shares for every preference shareholder. That is 6 new equity shares at the rate of 2.5 each means 12,000 into 6 new equity shares into 2.5 in the form of equity shares, which is equal to 1,80,000. For 6 lakhs, how much you are paying? 4,80,000 plus 1,80,000. 60,000 in excess you are paying, right? So that's where that excess of 60,000 you should need to transfer to reconstruction account. So then what is the journal entry? The journal entry is, first you should need to cancel the existing equity share preference share capital, that is 7% preference share capital, right? 7% preference share capital. In bracket face value, how much, guys? 50. Amount is how much? 6 lakhs. 2. So new preference share capital is 5% preference shares. To 5% preference share capital. In bracket face value 10, amount is 4,80,000. To equity share capital, in bracket 2.5, 1,80,000. The loss you can transfer to reconstruction account debit, not credit. Debit, because which is loss, 60,000. Now is it fine? This is all about entry number B. So right, you can come to point number C. Lenders to the company for 1,50,000 have agreed to convert their loan into the share, and for this purpose they will be allotted 12,000 new preference shares of 10 rupees each and 12,000 new equity shares of 2.5 each. 12,000 into 10 means 1,20,000. 12,000 into 2.5 means 30,000. No profit, no loss. So simply lenders means loan, that is out of this 5,73,000, he is talking about 1,50,000. So fourth entry, loan account that are 1,50,000 to 5% preference share capital 1,20,000 to equity share capital 30,000. Here bracket 2.5, here bracket 10 rupees. Is it fine, guys? Next, come to point number D. The directors have agreed to subscribe in cash 40,000 new equity shares of 2.50 each, in addition to any shares to be subscribed by them under A above. Here under A, some additional subscription is there. Apart from that, one more subscription, which is 40,000 into 2.5, 1 lakh. So additional subscription entry, bank account that are to equity share capital. So which is for 1 lakh, 40,000 equity shares at the rate of 2.5 each. That is point number D. Come to point number E. Of the cash received by the issue of new shares, rupees 2 lakhs is to be used to reduce the loan due by the company. Now we are discharging the loan account at R2 bank for 2 lakhs. That is the thing he is conveying through point number E. Next, you can come to point number F. The equity share capital cancelled is to be applied to write off the debit balance in the P&L account and to write off 35,000 from the value of the plant. So before checking all these things, what I will do first, I will check the balance under reconstruction account. From that balance, I will write off 35,000 for plant and remaining P&L account debit balance. Any balance remaining is to be used to written down the value of trademarks and goodwill. So after writing off these two, still if you are having any balance under reconstruction, then we can knock off the trademarks and goodwill. Show by journal entries how the financial books are affected by the scheme and prepare the balance sheet of the company after reconstruction. The nominal capital, that is authorized capital, as reduced is to be increased to 6,50,000 per preference and 7,50,000 for equity share capital. Why he is mentioning to increase the authorized share capital? Due to this reconstruction, if we are going to issue any new equity shares, if it crosses the existing authorized share capital, definitely they should need to alter the authorized share capital. For that purpose, at the first instant itself, they are clearly telling that no worries, the existing authorized capital is increased to 6.5 and 7.5. Okay. First, what I will do, I'll check the balance under reconstruction account here. All of you start with your calculator. First entry 7,12,500 credit. Second, nothing. Third, minus 60,000. Fourth, nothing. Fifth, nothing. Sixth, also nothing. Oh, that means 6,52,500. I have reconstruction account balance 6,52,500. Is it correct? Now, out of this, what is telling? To write off the debit balance of P&L. So P&L debit balance, how much I have? 4,51. So patents, sorry, not patents, plant is going to reduce 35,000. Still, how much balance is there under reconstruction after this? Still, I have 166,500. Now, with this 166,500, I should need to written off patents and goodwill. Sorry, trademarks and goodwill. Trademarks and goodwill costed 3,18,000, but I have only 1,66,500. That's why trademarks and goodwill I will written off with 1,66,500 only. Now you can pass the entry for this. Reconstruction account that are 6,52,500. To P&L 4,51,000. To plant 35,000. To trademarks and goodwill 1,66,500. Here also there is no balance under reconstruction account. This is the thing how you should need to pass the entries. This is seventh entry. Is it fine, guys, all of you? Sir, balance sheet I'm providing as HW. Balance sheet I already had under my PDF. So just I'm providing you as HW. Please all of you complete the balance sheet from your end. Then it will be practice for you. Okay. Yeah. So check all of you once again. If you're having any doubt, just let me know. So let's start the next problem after a gap of 2 minutes. I know it's a hectic task to listening one by one problem. Okay. So our sessions are lengthy and long. If it is difficult for you and for me as a teacher to teach one by one problem after another problem, it's too difficult from my point of view as well. So that's why take a deep breath for 2 minutes. And if you are having any problem, let me know. Yeah, friends, let's start with the next problem. So which is problem number 5. So which is a bit different problem. Please all of you concentrate. There is a reason to take this particular problem into the discussion. Important model. Sometimes they may test this type of problems as well. Repair Limited is in the hands of a receiver for debenture holders. Sir, who is receiver for debenture holders? You may understand our next chapter itself is the liquidation of companies. So certain times a particular person who is appointed to protect the interest of the debenture holders, we can talk it as a receiver for debenture holders. You know, in generally at the time of issue of debentures itself, a debenture trustee will be appointed to take care all the activities of the debentures, because you know debenture holders are a loan party to the company. They are not having any right to entering into the affairs of the entity. But even though there are those guys are the loan party, they may also contribute like equal amount to the shareholders, more than that as well. We don't know, depending upon their capital structure. So with involvement of use money and without involvement of company affairs, it's too difficult to protect the interest of such persons. At that point of time, the debenture trustees at the time of liquidation, they will either debenture trustees or debenture holders itself, they will appoint a receiver for debenture holders. That means directly liquidator may not involve into the affairs of the entity at the time of liquidation. First, receiver for debenture holders will coming to the picture. Up to the date of making payment to the debenture holders, the entire liquidation procedure is going to be handled by receiver only. Once amount payable to debenture holders will be over, then the surplus amount will be handed over to the liquidator. The remaining activities will be conducted by the liquidator. That is the procedure in generally happen when a receiver for debenture holders will be appointed by the debenture holders. So like that, he is telling that Repair Limited is in the hands of receiver for debenture holders who holds a charge on all assets except uncalled capital. That means he is having the authority to realize all the assets except an uncalled capital. The following statement shows the position as regards creditors as on 30th June 2015. What is the meaning of that sentence? Guys, if at all the liquidation of companies chapter will be over, you may understand the each and every terminology used in this particular problem. The following statement shows the position on as regards creditors. After making payment to creditors, the position will be look like this. Following statement he is talking. Following statement means it is not a balance sheet. I'm revealing right now itself, but people whenever they are reading the problem, they are always thinking that this is a balance sheet, but this is not a balance sheet. Okay. It is clearly given, which is a statement of position related to assets and liabilities after making payment to creditors as on 30th June 2015. So let me talk about the liabilities portion first. Under liabilities, so 6,000 shares of 60 each, 30 rupees to be paid up. That is related to equity share capital. So if you check under amount itself is not given. That's why it is not a balance sheet. I told you, which is a simple statement he is providing. First debentures are with 3 lakhs, second debentures are with 6 lakhs, unsecured trade payable is with 4 lakh 50,000. Property, plant and equipment cost is 3 lakh 90,000, estimated at 1 lakh 50,000. What is the meaning of that? If I sell that in outside market, the receiver for debenture holders may will get 1 lakh 50,000. Cash in hand of the receiver at 2 lakh 70,000. If they add these two, they are getting 4 lakh 20,000. Uncalled capital he is also providing here. That means apart from this 4 lakh 20,000, receiver for debenture holder is also having choice to make a call from the equity shareholders if the amount is not sufficient to repay to the other parties or the debenture holders. So that's why he added uncalled capital. Total he is having a choice 6 lakh worth of asset to make it distribute among the debenture holders. That is the point he is conveying. So deficit. So these are the total liabilities I have. Deficit he is telling 7 lakh 50,000. Is it the deficit is equal to P&L account or not, guys? All of you let me know. The deficit is equal to P&L account debit balance or not? Let me know in this problem, P&L account debit balance is how much? All of you. Can you please let me know? Muhammad Aslam. Sir, today last session for internal reconstruction of companies. No. Today is not the last session. Tomorrow we will consider another off for the internal reconstruction. Okay, it's already time will be 9 o'clock. We not yet discussed the surrender of shares concept as well. No, today let's discuss the surrender of shares concept as well as problem on surrender of shares. Rest of the things let's close today itself. Then for 2.5 sessions, it's simply enough for our liquidation of companies. Total we have 9 sessions, guys, not 8 sessions. Total we have 9 sessions. I think so. Today I'm as on 6th session. So tomorrow 6.5 we can consider the internal reconstruction. Then the remaining 2.5 that's sufficient for liquidation of companies. Okay, P&L is how much? P&L is how much in this problem? That is not 7,50,000, guys. It's not 7,50,000. They are just making a side track. If you are looking these figures, something like this, because this is not a balance sheet. Who should need to prepare the balance sheet? The speciality of this problem is we should need to prepare balance sheet our own. Then you should need to start the problem. This is a receiver for debenture holder statement after making payment to creditors. Now from the given information, you should need to prepare the balance sheet on your own. So, which is problem number 5. So first let me draft the balance sheet as on 30th June 2015. Now PPE, let me take up the assets here. PPE, property, plant and equipment, how much? Sir, it is estimated to realize at 1,50,000, but in balance sheet estimated realizable value you will show? No, cost 3,90,000. After providing depreciation from the cost you will show. So that's why this figure you should need to consider, not the estimated realizable value. Cash in hand of the receiver. Cash in hand is how much? Which is 2,70,000. Next, charged under debentures. If you include these two items, you will get 4,20,000, but it doesn't consider under balance sheet. This is total. Uncalled capital is not form of balance sheet, guys. At the time of liquidation, if the amount is insufficient to repay amount to the parties, then the liquidator will call for the shareholders for the uncalled capital. That's which is not form out of balance sheet. So that's it under asset side. Coming to equity and liabilities. Start with share capital. 6,000 shares into 30 rupees paid up. How much? 6,000 into 30? 1,80,000, right? So we can add here 1,80,000. First debentures 3 lakh. Okay. Second debenture 6 lakhs. Unsecured trade payables 4,50,000. There are no other line items we have. You can make it totals of the balance sheet. First, you can come with the credit, that is liabilities and equity side. 180 plus 3 lakhs plus 6 lakhs plus 4,50,000, which is equal to 15,30,000. 15,30,000. 3,90,000 plus 2,70,000 minus 15,30,000. What is this 8,70,000? You know, this 8,70,000 is P&L account debit balance. This is the figure you should need to find out through preparation of balance sheet. So indirectly, he is telling that you should need to find the P&L account balance sheet through preparation of balance sheet. So this deficiency 7,50,000 is not the P&L account debit balance. This is the P&L account debit balance, and this is the balance sheet you should need to work out. Next, okay, let me read the point by point. What the scheme of reconstruction? Let me check. A holds the first debentures for 3 lakhs. Okay, second debentures for 3 lakhs. He is also an unsecured creditor for 90,000. So one party is there and his name is A, who is holding first debentures, second debentures, as well as unsecured trade payable. First debentures for 3 lakhs, second debentures for another 3 lakhs, unsecured trade payable is for 90,000. B holds second debentures. So B is another party. He is not holding anything for first debentures. He is holding second debentures for 3 lakhs and unsecured trade payable for 60,000. Okay. The following scheme of reconstruction is proposed. Consider all of you. Out of the existing first and second debentures and unsecured trade payables, 2 persons, that is by A how much holded, B how much holded, they clearly provided for the first paragraph. And the following reconstruction procedure point by point they are providing. A is to cancel 2,10,000 of the total debt owing to him, to bring 30,000 in cash, and to take the first debentures in cancellation of those already issued to him for 5,10,000 in satisfaction of all his claims. All of you read the point number 1 once again and let me know the meaning of point number 1. Not require the accounting treatment. Let me know the meaning of point number 1. All of you please participate and let it put in the chat box. No, I'm not getting any answer till. No one is trying here. Okay, then I'll explain from my side. Concentrate. First, all of you, A is to cancel 2,10,000 of the total debt owing to him. A clearly told that I'm ready to sacrifice
Recording in
2,10,000.
progress.
I'm ready to sacrifice to the extent of 2,10,000 to bring 30,000 in cash. A is ready to introduce 30,000 cash into the organization. He is canceling, that is okay, and he is also ready to introduce 30,000 cash to take the first debentures. So he is ready to subscribe 30,000 first debentures in addition. Sir, first of all, A is holding 3 lakhs plus 3 lakhs plus 90,000, right? If he introduce another 30,000, for additional first debentures or new first debentures, these are new first debentures, subscription, then total how much amount should need to be payable by the company to A? 3 lakhs plus 3 lakhs plus 90,000 plus this 30,000. 6 lakhs 90 plus 30, which is equal to 7,20,000 is the total amount of the liability should need to be payable to A. Out of this 7,20,000, A is ready to sacrifice 2,10,000. How much? 2,10,000. Out of this 7,20,000, 2,10,000 is the sacrifice. For the remaining, how much will be 7,20,000 minus 2,10,000? The remaining will be 5,10,000, the balance. For the balance 5,10,000, in satisfaction of all his claims, what he is getting? And to take first debentures in cancellation of those already issued to him for rupees 5,10,000 in satisfaction of all his claims. Sorry guys, this 30,000 not in the form of new debentures. Just he provided cash. Just he provided cash means which is a liability. He's not expecting right now anything. Just he given cash to the organization. After giving this, he is working his total. So out of 7 lakh 20, I'm cancelling 2 lakh 10,000. Then for the balance of 5 lakh 10,000, he is expecting the new first debentures. That is the point he is telling. Sir, for all this, how I should need to provide the accounting treatment, sir? First, cash is given by the first debentures to the company. For that, first you should need to pass one entry. If as a company you are receiving the cash account debtor 30,000, that is inflow, to whom you should need to pay A account, that is 30,000. Now the total liability will become 7 lakh 20,000 because already existing liability 3 lakhs plus 3 lakhs plus 90. If you add this 30,000, it will become 7 lakh 20,000. Correct? Now these amounts are there in first, second, and unsecured trade payables. These you can cancel first, make it transfer to A account. For that, you should need to pass this entry. What is that entry? First debentures, second debentures, unsecured trade payable or unsecured loan or trade payable. What is that? Unsecured trade payable only. This is 3 lakhs. This is 3 lakhs. This is 90,000 to A account, which is 6 lakh 90,000. Now in your books, it is clearly showing that 30,000 here 6 lakh 90, total 7 lakh 20,000 is payable to Mr. A. Now out of which A is ready to sacrifice to the extent of 2 lakh 10,000. That's why you can make it credit reconstruction 2 lakh 10,000. Then for the remaining, we are issuing new first debentures for 5 lakh 10,000. Now you can cancel total 7 lakh 20,000. This is the impact of point number 1. Total 3 entries. You should receive the cash. First, second, unsecured trade payable portion of amount transferred to A. Then cancel the A account, transfer to the extent of sacrifice to reconstruction. For the remaining balance amount, you can simply transfer to, simply discharge in the form of new first debentures. This is all about Mr. A. Let me read point number 2 related to B. B is to accept 90,000 in cash in satisfaction of all claims by him. Not complicated. Very much easy. First of all, to B, how much amount we should need to pay? 3 lakhs plus 60,000, right? For that, you should need to transfer the entry, that is second debentures 3 lakhs, unsecured trade payable 60,000 to B account 3 lakhs 60,000. After that, what is happening? B is to accept 90,000 in cash in satisfaction of all his claims, means remaining amount is going to sacrifice, right? That is B account debtor 3 lakh 60,000 to bank. 3 lakh 60 minus 90,000. Remaining will be reconstruction. To reconstruction account, which is 3 lakh 60,000 minus 90,000, which is equal to 2 lakh 70,000. This is the entry with respect to B discharge. Next, coming to point number 3. In full settlement of 75% of the claim of unsecured creditors other than A and B. First of all, let me check unsecured trade payable other than A and B is how much? For unsecured trade payable other than A and B, out of this 4,50,000, 90,000 is held by A, 60,000 is held by B. 90 plus 60, 1,50,000. 450 minus 1,50,000 means 3 lakhs. So unsecured trade payable other than A and B is 3 lakhs, guys. Now what is talking? Out of that unsecured creditors other than A and B, 75% of the claim he is talking. One is 75%, other one is 25%. 75% claim means 3 lakhs into 75 means how much, guys? 2 lakh. 12,500. Sorry, 2,25,000, not 12,500. 2,25,000. Here it is 75,000. Okay. Now, in full settlement of this 75% claim, that is in full settlement of 2,25,000 of unsecured trade payables, agreed to accept 4 shares of 7.50 each fully paid against their claim for each share of 60. For 60 rupees claim, they are ready to take 4 shares of 7.50 each. 4 into 7.5, 30. That means for every 60 rupees claim, they are ready to accept 30 rupees. What about remaining 30? That is 50% they are ready to take equity shares. For the remaining 50%, they are ready to sacrifice. Out of this 2,25,000, simply 50% in the form of equity shares, they are ready to agree. For the remaining 50%, they are ready to sacrifice. That is the point indirectly they are conveying. It is clearly given if you read 4 shares of 7.50 each fully paid against their claim of each share of 60. For every 60 rupees, they are accepting 4 into 7.5, 30 rupees. That means out of this 50% in the form of equity shares, 50% sacrifice. Just wait. The balance of 25% is to be postponed and to be payable at the end of the 3 years from the date of the court approval of the scheme. That means for the remaining 25%, just they are treating it as a long-term or non-current liability. In the balance sheet, it is showing as a non-current liability. Now for this 2,25,000, what is the entry I should need to write? Unsecured trade payable 2,25,000 to reconstruction account 1,12,500 to equity share capital 1,12,500 in bracket face value 1.5. If you check, the equity shares they are issuing at the rate of 7.5 rupees only. That's why in bracket you can clearly show 7.5 rupees each. Okay, fine. Next, you can come to the point number 4. So point number 3 is completely over. Come to point number 4. Uncalled capital is to be called up in full and 52.50 per share cancelled, thus making the shares of rupees 7.50 each. That is the reason why they are issuing the shares at the rate of 7.5 each. If you check here, out of the 60 rupees face value, first uncalled capital is to be called up. 60 rupees face value, 30 rupees was already paid up. Uncalled capital is remaining 30 rupees. First, that remaining 30, they are making a call. At the time of making a call, so bank account at R2, tell me guys, what is the entry? Call account. After that, call to capital. Or else if you want, make it direct entry, bank to capital. That is how much amount? 6,000 into 30, that is 1,80,000. So the next entry is first to make a call. For that, bank account at R2, share capital, 6,000 shares into 30 rupees, which is 1,80,000. Now the shares are fully paid up. Fully paid up means each and every share value is 60 rupees. After that, 52.50 per share was cancelled. 52.50 per share means equity share capital account at R, cancel 60 rupees face value to equity share capital, issue the new equity share at the rate of 7.50 each, remaining to reconstruction account. That is 6,000 into 60, 3,60,000 here. 6,000 into 7.5, 45,000 here. Remaining 3,15,000 reconstruction. So that is the reason why here the equity shares are issued at the rate of 7.5 each. This is the impact for last point, that is for point number 4. Assuming that that scheme is duly approved by all the parties interested by the court, give necessary journal entries. Only they are asking to pass necessary journal entries. No need to give any balance sheet. This is the end of problem number 5. If you are having any doubt, just let me know, sir. Is it clear? Muhammad, what happened to you? Are sad? Are you feeling crazy? So you can take 2 minutes time to understand the issues once again. If you require, if you're having any doubts, just let me know before starting with the next problem. I'll try to start the next problem also in this session. And the next problem, that is problem number 6, I'll try to explain through my PDF. I don't want to do anything under my OneNote. Okay. Guys, are you ready to start the next problem? So let me start problem number 6. The balance sheet of Fiber Limited as on 31st March 2014 is as follows. PP is given. Investments market value is at 19 lakhs. So, but book value is at 20 lakhs. Current assets given. P&L account debit balance directly given at 12 lakhs. Equity shares face value 100. Cumulative preference shares face value also 100. Debentures are also 100. Creditors given. Provision for taxation given. Following scheme of internal reconstruction is sanctioned. What they required, first let me check the requirement. Journal entries they required, balance sheet also they required. Anyway, balance sheet is your cup of tea. I'll explain the journal entries through the help of my PDF. All the existing equity shares are reduced to 40 each. If all the existing equity shares are reduced to 40 means equity share capital 80 lakhs you should need to cancel. That is face value 100. To equity share capital you should need to create at the rate of 60. To equity share capital at the rate of 40, to reconstruction at the rate of 40 you should need to transfer. Now the entry is equity share capital 100, you cancel total the given amount, which is how much? For 2 lakhs, 2 lakhs or 200 lakhs, 200 lakhs you cancel. The new equity share capital shares for 200 lakhs means at the rate of 100 means 2 lakh equity shares. That's for 2 lakh into 60 will be the new equity share capital. 2 lakh into 60 or 2 lakh into 40, 1 second. Reduced to 240. Reduced to 240 means 60 rupees is the reconstruction, sorry. 40 rupees will be the share capital. Earlier, just I mentioned wrongly. I thought of it was reduced by 40. Sorry, it is reduced to 240 means 60 rupees is the reduction, 40 rupees is the new face value. That's why 42 lakhs into 40 will be the new equity share capital. Reconstruction 2 lakhs into 60, which is 120 lakhs. Next, if you come to the second point, all preference shares are reduced to 60. Reduced to 260 means, so reconstruction 40 rupees per share, new equity share capital 60 rupees per share. That's why 60 multiplied with the number of shares, cumulative preference share capital 1 lakh multiplied with 40, you will get reconstruction account. Is it okay? Point number 1 and 2, no difficulty. The rate of interest on debentures increased to 6%, existing 5%. Okay. The debenture holders surrender their existing debentures of 100 each, and the exchange the same for fresh debentures of 70 rupees each for every debenture held by them. Sir, for 100 they are converted to 70 means 30 rupees is the reconstruction profit. If you are cancelling 5% debentures, then 5% debentures account are to 6% debentures to reconstruction account. That is number of debentures into 30 reconstruction, number of debentures into 70 new 6% debentures, old 5% debentures you should need to cancel. So old 100 cancel, new 70 credited, remaining balance reconstruction account. Is it okay? Old 5, new 6. Old 100, new 70. Remaining 30, 80,000 into 30 will be the reconstruction account. Next, you can come to the point number 4. PPE are to be written down by 20%. PPE written down by 20% means reconstruction to PPE. So reconstruction account are to PPE 50 lakhs. Maybe one combined entry I worked out. Current assets are to be revalued at 90 lakhs. So current assets book value is given at 200 lakhs. If such 200 lakhs is valued at 90 lakhs means 110 lakh is reconstruction loss. That's why reconstruction total 50 plus 110. Still one more entry is there. One more aspect is there. So just you can consider the current assets up to this. Reconstruction to PPE, reconstruction to current assets. Let me read the further. Investments are to be brought to their market value. Brought to their market value means 20 lakhs to 19 lakhs means 1 lakh again reconstruction loss. That is reconstruction to investment, that is 1 lakh. Now, if you combine these three components, 50 plus 110, 160 plus 1, 161. That's why I given reconstruction debit 161. The 3 points combinedly I done fourth entry. Next, seventh one of the creditors of the company to whom the company owes 40 lakhs decides to forego 40% of his claim. 40 lakhs into 40% means 16 lakhs will be the reconstruction. The creditor is allowed 60,000 equity shares of 40. Out of this 40 lakhs, 16 lakhs will be the reconstruction means remaining 24 lakhs. They are going to settle through issue of equity shares. That is 60,000 into 40 means it will be 24 lakhs. So the entry is creditors 40 lakhs to reconstruction 16 lakhs to equity share capital 24 lakhs. So the same entry here they passed. Next, the taxation liability is settled at 3 lakhs. That is, whenever you are settling any excess liability, which was unrecorded liability, here the taxation liability was not existing in the balance sheet. If you check, exist. Okay, sorry, it is exist. If it is not there, direct entry reconstruction to bank. But here it is exist. Provision for taxation 2 lakhs is exist. Okay, the taxation liability is settled for 3 lakhs. Now the entry provision for tax 2 lakhs to bank 3 lakhs. The excess of 1 lakh, you can make it transfer to reconstruction, which is loss 1 lakh. If nothing is there in the balance sheet, the provision for taxation, then direct entry reconstruction to bank 3 lakhs. Do you understand? So now the same entry here, the worked out provision for tax 2 lakhs, reconstruction 1 lakh, to bank 3 lakhs. Next, it is decided to write off the debit balance of P&L account. After checking all these things, we should need to find out the reconstruction balance. With that P&L account debit balance, we should need to knock off. So don't check the seventh entry. First, you can cross verify how much balance is there under reconstruction account. Point number 1, 120 lakhs plus. Point number 2, 40 lakhs plus. Third entry, reconstruction plus 24 lakhs. Fourth entry, minus 161 lakhs. Fifth entry, minus 16 lakhs. Sixth entry, minus 1 lakh. So total I have balance under reconstruction account 6 lakhs, guys. With that 6 lakhs, P&L account debit balance how much? 12 lakhs I have. No, can you please check one more time? I'm getting the different reconstruction account balance, but here it is getting 38 lakhs. Is it any committed, any clerical mistake in calculator? Let me check one more time. Please, all of you concentrate. Under first entry, which is 120 lakhs, yes, 120. Plus in the second entry, I got 40 lakhs plus 40. Third entry, plus 24 lakhs plus 24. In fourth entry, reconstruction debit 161, that's why minus 161. Okay. Fifth entry, plus 16 lakhs plus 16. And in the sixth entry, minus 1 lakh. Yeah, it's wrong, guys. Calculator wrongly made. Earlier 38 lakhs. Right now I'm getting the reconstruction account balance. If you want, you can cross verify, which is 38 lakhs. Okay. So out of this 38 lakhs, P&L account debit balance is 12 lakhs. The remaining balance means 28, 26, 26 lakhs will go to capital reserve. So reconstruction account 38 lakhs, P&L account debit balance 12 lakh, capital reserve 26 lakhs. That's it. Balance sheet is HW for you. Okay. So with this, all the major problems, how we should need to handle the reconstruction problems, just I told you. You know, n number of problems we can able to create under reconstruction, because the scheme of valuation or the scheme itself may be different from one type of company to another company based upon the agreements entered between company and the parties. So just rather than doing n number of problems, it is better to learn the concept how we should need to handle a particular situation. And art of drawing the balance sheet after reconstruction also, please all of you learn from your side, because it's too difficult in the examination to recollect each and every point accurately and put it in the balance sheet. It's the way of practice you will get that particular part. Okay, so this is the thing officially. Just I'm handovering for the reconstruction other than surrender of shares concept. In tomorrow's session, let me explain the surrender of shares concept, and we'll do one problem on the surrender of shares. Then we'll close entirely the reconstruction, internal reconstruction chapter. In tomorrow itself, we are going to start with the liquidation of companies chapter as well. Just let us allocate 2.5 sessions for the liquidation of companies. It is more than enough. Then we will be complete the entire syllabus at on time with good picture and the clarity. So once internal reconstruction also be completed, I'll try to upload the same PDF as like how I uploaded in case of amalgamation. Hope you found the amalgamation, my handwritten PDF. So similarly, tomorrow I'll upload this particular document. Until bye guys, have a nice day.